Good morning, good afternoon, good evening, all depending on where you're joining us from. But regardless, a very warm welcome to the session today. On behalf of ThirdBridge, I'm delighted to welcome everybody, including our panel. For those of you with good memories, earlier this year, we released our PE forecast where we surveyed senior leaders within the US private equity space, touching on issues such as fundraising, deployment, deal flow, valuation. And one of the other interesting insights to come out of said report was that alongside AI within TMT, infrastructure was actually one of the segments that had the largest bid-ask spread, and that was expected to remain for the next year or so. And as such, we decided to focus today on infrastructure. I think, given its historic reputation as being relatively staid, these are capital-intensive assets. The cash flows are privileged or very, very visible, and as such, I think folks have historically, thought it may be quite a boring space. But given some of the trends and developments we're seeing on a global basis, I don't think anybody can say today that infrastructure is boring. You have accelerating cost of capital, you have high inflation, you have geopolitical tension, you have governments that are increasingly looking to take a very active role within the infrastructure space, not just within clean energy, but actually across the spectrum of assets more generally. And so, we wanted to spend the next 45 minutes or so talking through some of the risks and opportunities that's creating for managers. And, helping me in that endeavor is of course, Joshua Maxey, co-founder here at ThirdBridge, Harriet Matthews, senior funds editor at Mergermarket, and Peter McNally, global sector team lead for industrials, materials, and energy. And obviously for introductions, my name is Dan Thomas. I'm a sector analyst at ThirdBridge as well. In terms of housekeeping, for those joining us live who would like to submit questions, please do so using the speech box in the top left-hand corner of your screen, and one of the team will pass your question along to the panelist at the end when we make space for a Q&A. But with that said, given we've got quite a lot to get through, I'm going to jump straight in. Joshua, with you. Just keen to get your take on PE deal flow looking forwards. I mean, we obviously spoke a couple of months ago. Interested to hear if anything's changed.
Yeah, I mean, in a nutshell, the clients I've been speaking to, not much has changed since the last time. I think it's fair to say that there have been some brighter spots. There are some more sell-side due diligences happening, and clients are getting ready supposedly for a 24, increased sort of, deal flow. But overall, we've seen a slight improvement, but it's nothing near any of the levels we've seen in the past. Midmarket is certainly a lot stronger for obvious reasons, but yeah, I would say that there hasn't been a marked shift in transactions in the space.
I think there was quite a lot of hope for Q4 a bit earlier in the year, but that hope keeps kind of continually shifting into the future. But private equity practitioners have to be eternally optimistic. They are raising funds and they are seeing opportunities into which they can deploy that capital. It's just a question of how and when. We're tracking some quite exciting processes at Mergermarket in the UK tech sector, for example, looking at Civica, backed by Partners Group, and Zealous, which is backed by Bain. The former, this is a software provider, and the latter is sort of more focused on HR software. So businesses are coming to market where there is conviction on the side of the seller that they will transact, because we have still been seeing processes fall over on buyer-seller valuation gaps. As you say, Josh, I think this is starting to normalize. I think part of it is kind of a mental shift that needs to happen, hopefully in early 2024. But it's challenging when people's models will be thrown slightly out of whack by the higher cost of capital. So it's a difficult time to be buying and selling businesses, candidly. But at the same time, we've seen Europe-targeted PE fundraising totaling $153 billion this year, which is nothing to be sniffed at. Not a bad year by any means. So there is, eternally feel like a broken record. There is a lot of dry powder. We just need to see it kind of shifting into being deployed, and there is a lot of hope on next year. So I'd agree with you on that.
I mean, of course, the other segment that is very active is mid-market for obvious reasons. Financing is obviously a lot easier. There are a lot more buyers present there. So, I continually hear that in mid-market things are still very, very pretty good.
I was starting to see evidence that bid-ask spread is narrowing, and that there's a meeting of the minds between buyers and sellers now. I think given, just before we joined the webinar, we saw news that EQT had potentially reignited their interest in Global Switch, noting obviously that deal, kind of that discussion sort of broke down earlier on in the year, or actually late last year, with a valuation of about 10 billion, and actually in conversation appears to be restarting at around 6.5 billion. And so I'm curious, do you think that shows sufficient evidence that bid-ask spread is narrowing, and we can expect to see more deals happening now?
I think so. I mean, I think next year for sure, sellers' expectations will come down, to realistic levels. That should be enough of a catalyst to ignite more transactions in the market. I think also, when you talk about, for example, take private situations, historically, when you speak to people who've been around, in this market for a long time and seen many cycles, they will always tell you that it takes a good while for boards at public companies to become comfortable with the offers that have been put out on the table. And we are now getting towards the end of that sort of cycle, I would say, where you are now seeing boards accepting that, and there should be, in theory, more of a propensity for them to accept some of those offers. And so I think that in the absence of secondaries and the other types of normal private equity transactions we've seen in the past, I think take private situations, for example, is one area where you would expect to start seeing boards accept some of those prices.
Harry, I mean, leveraging obviously some of the data that you have at your disposal, are there any particular areas or hotspots of deal activity that you might see now or expect to see in the near future?
I mean, some of this is sector dependent, but some of it is also around business models and, things like recurring revenues, things like visible cash flows. And some of the businesses that do characteristically fit that kind of model will be certain parts of technology. Business services is a big one, and anything that can be consolidated, any sector that can be consolidated is still kind of at the forefront of private equity's mind, partly because of the rising cost of capital. More operational improvement needs to happen, more kind of buy and build expertise needs to be used in these types of situations. So partly around sectors and partly around business models where we're seeing deals go through still.
What about just in the infrastructure space in particular? Do you see any particularly exciting areas for deal activity?
I think infrastructure is an interesting asset class, and obviously that's the main topic of our discussion today. When you dig into some of the details, first of all, what's the same? That's the way I would look at it. What is the same between infrastructure and private equity, and where does it differ? And I think that those are sort of the relevant questions here to ask. And when I look at it in terms of fundraisings, deal flow, it's under pressure in the same way as most private equity, as an asset class is. And I've seen some stats suggesting that the funds are coming in at about 88% of target this year. So it's not terrible. I mean, but it was 116% in the past two prior years. So of course it's challenged, and the hurdle rate has increased. Financings are much more of a challenge. And what is also the same is that you're seeing bifurcated asset flows. What I mean by that is that you're seeing the large players still accumulate a large part of the pie, and the smaller players are struggling. So that is all the same. But what I do think is different with infrastructures is that you've got this huge clean energy shift. You've got this energy transition. You've got obviously much more stable cash flows, predictable. And so I think that is certainly where infrastructure is headed. And I saw one stat that suggested that 90% of electricity investments are all in renewables globally. So that just gives you some indication in terms of just how much momentum there is there. And I think also on the exit side, you've got a very different dynamic, which makes that asset class attractive, because you've got large utilities, for example, that have to have renewables on their balance sheet. And so it makes them, in a way, force buyers in the market who are willing to pay up the price and put, reasonable offers on the table. So I think that when you go from core to core plus, as many people like to refer to it, I think there is definitely that's the area where there's a lot of momentum. Now that presents a lot of other challenges in terms of due diligence and LPs, but I think we'll probably talk about that later, right?
Yeah. Harriet, maybe one for you, and obviously referring back to the report where the bid-ask spread is wide. How are investors looking at getting access to the infrastructure asset class, given some of the benefits that it provides? How are they approaching getting access, given the significant difference that still remains between buyer and seller expectations?
Well, what's been interesting to see is some businesses actually are still, some deals are transacting at quite high valuations. Those are ones where there's a kind of green transformation case around them, and kind of solid business model. My colleagues at Infrastructure, which is another kind of service within the Ion Analytics platform, alongside Mergermarket. They've been reporting on Fjord One, a ferry group which was acquired by DIF, among others. And that actually still got done at a price that would have been higher than it may have got done at 2 years ago, for example. So, in some cases, people are just able to kind of transact as normal. In other cases, people are just needing to hold assets for longer, essentially. Maybe we'll talk about this a bit later, but GP-led secondaries, there's a huge amount of potential for that in the infra space. Infra assets already have longer holding periods anyway. So, a GP-led secondary kind of works. It makes sense. It's less disruptive for the business when there's no actual ownership change, no capital structure change. It's being transferred from one fund to another. Different LPs and secondaries investors can come in and get exposure to that particular asset or a group of assets if it's a kind of multi-asset continuation vehicle. So that's one option for deals where the current owner may feel it's not quite the right time to exit them on the kind of open M&A market.
What do you think is going to be a more significant factor or aspect there, the continuation piece or more LP-led kind of secondary stake sales?
Infrastructure is a smaller and younger asset class than private equity is, and we can see that just in the fundraising figures. Particularly strong year for global infrastructure fundraising last year was 140 billion. This year it's down to 20.6 billion, which is quite a jump. But private equity in a sort of not so positive year even this year has raised $153 billion. This is for the European market in the year to date. So just kind of comparing and contrasting that, there's a huge amount of opportunity. And there are still a huge number of institutional investors looking at the primary fund level to get into infrastructure. And that appetite for exposure and diversification has also been evidenced by the fact that we've got people like CVC and Bridgepoint buying infrastructure managers. The expertise that those teams have is really important, really valuable. You can't just start an infrastructure strategy. You are probably going to need to buy or at least get in the people with the right expertise.
What do you kind of take, or what's your take on that? To Harriet's point, you've got obviously larger funds coming in and buying infrastructure platforms directly. How do you think about the implications of that as part of the wider kind of PE landscape?
Yeah, I think, and I've actually heard this from a number of my clients, is that a lot of these firms want to become platforms and they want to be diversified and they want to be multi-managers. And I think that is part of this play, CVC, Bridgepoint. So I think this is just what we're seeing. And I think the asset class itself lends itself very well to a number of LPs who want to have that predictable, longer duration type return. And so there is a bit of a matching, effect going on here as well. So no, I think it's really part of the strategy that some of the larger funds have got, which I would expect us to see more of that going forward in the future as well.
We have a number of questions already that have come in from the audience on some of these points, but we'll potentially save those for the Q&A at the end. And so with that, I'm keen to turn over to Peter. Peter, welcome. Referring back to the report, that forecast has obviously shown the expectation that bid-ask spreads will remain wide in the infrastructure space, not least in energy, over the next 12 months. And I'm just curious how maybe you're thinking about the market opportunity within infrastructure.
Well, I think there's two different categories that we like to think of on infrastructure that encompasses lots of different areas in the economy and the market. On the one hand, you have the kind of the more legacy things that, roads, bridges, tolls, utilities, things like that, existing physical assets. And at times they need catch up. They need, money to bolster the assets, as they are today. And then we have the growth areas, right? And as Josh mentioned, some of the renewable growth that we're seeing, but also data centers, life sciences. And those are more greenfield type investments. And, those are valuations there are going to be influenced a lot by that discount rate and borrowing costs. But, more on the energy side, energy covers a lot. If we're not just talking oil, natural gas, electricity, biofuels have, now entered, the market. We've seen a lot of volatility in those prices. And it's hard to get buyers and sellers to agree on what the right price into the future is. And when you look out in the future in most of these commodities, so you see lower prices in the future because there's more capacity, but it hasn't stopped the volatility that we've been seeing. And if I roll back, let's say to the summer of 2022, Europe, the US, there was a lot more volatility in power prices, and the summer of 2023, a bit less so, or a lot less so, because frankly, the system didn't break down, and there weren't as many disruptions that we had seen prior. So that's kind of how we would bucket the market and why we're seeing some of those wider bid-ask spreads.
Maybe some of the trends and the themes that we alluded to at the start, one of which was obviously increasing government participation in the infrastructure space. We can maybe touch on utilities in the UK, or we can talk to the IRA, the Inflation Reduction Act. I'm curious, what opportunities and risks in your mind are being created as a result of an increasingly activist government in the infrastructure space?
Well, why don't we start with water utilities in the UK, where we see a lot of interest, particularly at Third Bridge Forum in it. And there's an easy narrative, I think, that gets told that this was an industry that got privatized, and the investors that took over these assets paid themselves dividends and didn't invest enough. And, the lack of investment is partially true, but part of the story here is changing government regulations. And it's made it quite difficult for these utilities to invest. Now, there are big investments that need to get done here, okay? And our estimates are that over the next decade, CapEx has to be 50% higher. And that's something that the owners are going to have to live with. But the consistent theme here is changing government regulations. Whereas I would say in the power side, or what we've discovered from talking to our experts, and that they've made it a lot more easy to invest in power. And we've seen growth in solar and wind in the UK. But this situation with Thames Water or Yorkshire and these other companies, it is a struggle, and there's going to be more investment needed, and it's going to take cooperation from the government.
In terms of how do you see that kind of issue or that challenge being addressed? Is it through tariffs going up, or are sponsors or asset owners, are they going to have to inject more by way of capital, or is it likely to be kind of a combination of the two? If we use the water utility example,
it's certainly going to be all of the above. It's going to have to be higher rates. The part of the problem here is the already high debt levels in this industry, and divestitures are not going to be that easy because there's going to be, more investment required. Whereas in, some other areas, I think it's going to be easier to do. But we are looking at higher rates, higher investment, and, also a difficult supply chain, and, is one of the other factors that's going to play out here.
You touched on growth categories within the infrastructure space. Maybe you could just share some more kind of color around those.
Well, as I noted earlier, this past summer was remarkable in terms of just how hot it was and power demand loads in both Europe and the US. Yet really, except in a couple local spots, the system didn't break down. And there's been a lot of capacity that has been added, solar, wind, and I think something that's really starting to emerge here is battery backup, for these systems. And, Northvolt has been something that's now talking about an IPO next year, or something around $20 billion. But batteries are making a difference. The business models and competition from China also come into play here, but there's certainly been a lot of capacity added with government encouragement, for sure. However, power prices have cooled off here. And, where I sit here in the U.S., there's competition from cheap natural gas. We had this cancellation here in New Jersey on a big power project just yesterday from Ørsted, the Danish utility. But, there's a lot of moving dynamics here, in this sector that's just going to complicate it for private investors.
Do you think that Ørsted example in particular points to additional challenges, particularly within existing projects in the renewable space? How far do you view that as kind of sector wide versus more kind of idiosyncratic?
Well, I think that situation may be more idiosyncratic here on the East Coast. Governments are encouraging this stuff. For sure, it comes down to economics, and is really the issue. And higher rates, higher costs, and lower power prices are making this a lot more difficult in this part of the country. Geography really matters, for sure. And this is a part of the world where gas is cheap and abundant. Europe doesn't have that anymore. That went away with Russia. It really, geography matters here.
Understood. What are some of the challenges that private equity investors face investing in infrastructure at the moment? I think in particular, if we can touch on, again, government involvement like the Inflation Reduction Act, do you see that throwing up any particular acute challenges?
Well, in theory, the Inflation Reduction Act was going to change a lot, and then in practice, we're finding out it's a lot more complicated, and there's a lot of devil in the details in terms of domestic sourcing. And this is an area where, the supply chain issues have gone away that, let's say, started during COVID, that pretty much manifested itself everywhere. And I would say that the two areas where it's still kind of a persistent problem would be in the aerospace sector and in this renewable sector. And the idea that you need, U.S. produced steel, let's say, to mount a solar tracker or some low value part of a solar panel has to be sourced in the United States, and what those rules are. It's making it very difficult to actually deploy the capital. So there have been a lot of projects that have kind of been held up as they await for clarity on what actually qualifies for the credits in the Inflation Reduction Act. And so 2024 is going to be a big year for hopefully clearing that stuff up, but it is also adding to the costs of these projects in the renewable space.
How do you view maybe, I guess, the relative attractiveness of direct investment in these assets that are core to the energy transition versus maybe investing in the supply chain or the facilitators? Because some of the challenges, to your point, that we've seen in some of the offshore projects have been challenges within the supply chain and the supply chain not being able to keep up and what have you. So I'm curious where you maybe view the relative kind of risk reward or opportunity being.
Well, I think maybe let's go back to the beginning of talking about greenfield versus brownfield. I think here in the United States, for infrastructure, there's a lot of value in the brownfield. That's what I would say is that really we don't have a lot of offshore wind and which is making the cost of the supply chain very high. But hydrogen is an interesting area here in particular because a lot of it comes from natural gas, believe it or not. You're not investing in new technology. It's basically steam methane reformers that have been used for decades, and not the green hydrogen that uses electrolysis, where there have been some struggles that we've seen to really scale it up. But at the same time, transportation of hydrogen is able to leverage the pipeline network that we have here in the United States. So the government just, we granted 7 hubs for hydrogen in the United States. And it does present an opportunity for a lot of those brownfield assets, to really make some money here.
How, this is maybe a public markets example, but how important do you think the Northvolt IPO is in terms of, establishing multiples in the market?
Well, Northvolt does have an important legacy from Tesla, right? Which has been, by all accounts, extremely successful, right? In terms of the ability to deliver over 1 million cars a year on a consistent basis and do it profitably. The Northvolt model, looking at doing it in an integrated way from raw materials really is something that I think public investors are going to find attractive. But I think that there are going to be two questions that public investors may, pose to them is like, one will be a smaller one. Part of the business is going to be recycling, of batteries. And that has proven to be difficult for everyone. It's sort of more, newer technology and the questions around whether people can do it. But it's Chinese competition is really going to be the big story for Northvolt. And cheap, renewable, like particularly in the PV or the photovoltaic side, is from China is having a big impact in these domestic markets. I mean, under the prior administration, we really here in the United States, we limited the amount of solar equipment that could come from China, but sorting those things out are going to be hard. But the world's biggest battery player, contemporary Amperex CATL, is going to be a big challenge for Northvolt. But so far it's been pretty successful in terms of scaling up. They're looking at more expansions here in North America, so certainly one to watch.
How do you think about opportunities within hydrogen specifically then? Because that's one of those ones that's always kind of front and center, and there's green hydrogen, there's blue hydrogen, there's a different color of hydrogen every other month. So I'm just curious, especially given some of the practical challenges on the electrolysis side that you're familiar with. How are you viewing that as an opportunity?
Yeah, look, if you want to look at infrastructure, there's this massive project in Saudi Arabia called NEOM that is trying to do green hydrogen. And, they announced a big cost overrun earlier this year. It's an $8.5 billion project. It was something under $6 billion. And some of it's not just down to the electrolyzers. It's steel and valves and compressors and things like that are all kind of adding up. And you're doing it again in a part of the world that doesn't have a lot of infrastructure to do these things. Blue hydrogen, particularly, when you're doing natural gas and carbon capture with it, this stuff is proven. And as I've said, earlier, the United States has a lot of natural gas that's pretty cheap. And there's probably even more of it coming, particularly out of Texas. And turning that natural gas, that methane, into, its component parts, carbon, and capturing that, and then the hydrogen, and using that as an industrial, source, does present a pretty unique opportunity, I think, here in the United States. We're starting to see certainly some PE activity in the pipeline space, even like public companies, as well. But a lot of assets have started to change hands here, is something that we haven't seen in quite a while. And I think part of it does have to do with the changing dynamics in natural gas and hydrogen in the United States.
Maybe on biofuels as well. We've had a couple of questions there, and I know that's a place you've done some work, Peter, particularly in the context of SAF, sustainable aviation. How are you again thinking about the risks and opportunities that investments within the biofuel space in particular presents?
Yeah. Well, Dan, maybe let's start with the risks. And it's pretty simple in the short term. We've overbuilt. Okay. This is thanks to government incentives, particularly in California, in the United States, but also in Europe, lots of companies have gone and taken subscale crude oil refineries and converted them into biofuel facilities. And frankly, we've overdone it, and our experts are telling us that this situation likely persists until 2025. But there'll be more mandates coming, certainly around, SAF is a smaller part of it, but renewable diesel is just going to be a much bigger market. Could it get to the same size of what we have here in terms of ethanol? Like 10% of our gasoline pool in the United States comes from ethanol, corn-based ethanol. hasn't always been particularly profitable, but renewable diesel has been different. Yeah, the market's about 3 times bigger than what we would think for jet fuel is going to be. But that, we're dealing with kind of one of these situations where the short term is overbuilt, but the long term, there's clear demand for it. And companies have made money, which is what, in this business, which is what has attracted the capital and the capacity in the first place.
Are there any other areas where you are seeing particularly interesting businesses cropping up as part of the energy transition?
Well, again, I would, go back to, power at the beginning, and we've added all this capacity. I think that the electric grid is something that is going to continue to, require investment. I mean, renewables, there's like changing dynamics that goes on and where power is generated and how it is generated. But the grid is always going to be something that, historically hasn't gotten, enough investment, I would say at times, but where power, where and how power is being generated is creating some interesting dynamics on the grid side.
Thank you, Peter. I think now is maybe a good time to just switch over to the Q&A. We've got a few that have come in. So Joshua, I'll start with you. Just on given the subject of the webinar, why infrastructure? Why now?
Yeah, I think, there's a couple of things I would highlight, and I actually, had some notes that I sort of prepared as well. I think, when you look at it from a macro perspective, you've got, and it's not necessarily why now, but it's always been attractive because you've got inflation-linked revenue. And obviously now, at the moment, when you've in a high inflation environment, that's one of the attractive parts of infrastructure. I will caveat that though with a big other point, which is that you do only get so far with that one because ultimately your cost of capital has obviously risen significantly as well. So the real value or the relative value that you're getting from infrastructure is arguably much tighter now than it was before. But that said, still, having inflation-linked revenue is an attractive component of infrastructure, and we shouldn't forget that. I think the other part would be from a supply perspective, you've got aging infrastructure, across the world, and we're seeing that, in many, many countries. So, there is definitely a demand, for deals to be had in that space. You've got secular tailwinds, I call it the 4Ds. You've got decarbonization, digitization, deglobalization, and demographics. And I think in the digital part especially, many of the conversations I've had with clients are really centered around data centers, edge data centers. And, it's like data electricity has become like the new oil. And so I think that is a really, really attractive part of, the infrastructure segment that has garnered, interest from clients. It has obviously got an intrinsic resilience as well that, people expect when they invest in infrastructure. So I think that is something, it's, little correlation to GDP. So that again makes it attractive. And it's a very good match for pension funds, which I said earlier, the long duration matches pension fund liabilities very, very nicely. And the energy transition, obviously, that we're going through right now, as we've discussed at length, I think is another really, really important aspect of this. On the buyer side, I mentioned this earlier as well, is there are an interesting set of trade buyers that are presenting themselves that make this also, because, the exit environment is challenged at the moment. There's no IPOs, and it's just becoming a lot bigger concern for investors. Now, when you've got a set of trade buyers that actually have to have some of these assets on their balance sheets in the long run, then it makes it an attractive investment opportunity. But that's not to say it's fraught with a lot of risks and challenges. Absolutely.
Harriet, in terms of your forward-looking perspective, are there any particular jurisdictions where you expect deal flow to be particularly active?
So traditionally, looking at infrastructure deal flow, the North American market is the most active, and that's been consistent after 2022, which was a strong year for deal flow. 2023 is obviously a little bit further down. I did take a look at what was showing as being kind of fairly high up in the kind of Mergermarket service, looking at our likely to exit algorithm just before we all joined here today. So that assigns companies with a score between 1 and 100, various data inputs, and essentially that score is going to tell you how likely a sponsor is to exit a particular company in the next 12 to 24 months. And just looking at, what it kind of, what cropped up there, quite a few opportunities in the UK, actually. There's been reporting around Instavolt, a UK-based EV charging infrastructure installer that's owned by EQT Infrastructure, has a relatively high score within our algorithm. Again, in the UK, CubeLogic, this is an infrastructure services provider, so kind of infrastructure adjacent, but those services providers are something that private equity particularly likes to invest in. And one more example I can give in this context is in Australia. Obviously, there's a lot of activity there sort of within the infra space sort of traditionally. One company that our algorithm has kind of tipped here is AirTrunk. That's a hyperscale data center provider. We've mentioned data centers a few times already. It's owned by Macquarie. And there have been reports on that the sponsor is exploring an IPO or a stake sale. Nothing official there yet, of course. But that hopefully gives a relatively good idea of where there might be activity in terms of sectors in a couple of geographies as well.
We touched on it during the discussion, but given the long lives of these assets and some of the end-of-life fund constraints that managers are facing, how are they kind of approaching those challenges or navigating those challenges at the moment?
So, infrastructure funds do typically have a longer lifespan than PE funds anyway. So, and, we were talking about the long-term return profiles. As an institutional investor, you do expect your capital will be locked up for a bit longer. But, in terms of the kind of playbook of how to generate some liquidity in these assets, of course, there's minority stake sales as an option that can be explored. And again, we spoke a little bit earlier about GP-led secondaries. If a sponsor wants to take, the whole asset or a group of assets from one fund to another. So those are the kind of options, and of course, refinancing as and when the debt is available. And actually the kind of quite acute problems of debt shortage that has been particularly problematic in large cap PE, that's not been as acute in infrastructure, especially core infrastructure. So refinancing does remain an option.
And that's just due to the quality of the assets themselves?
Yes, so it's kind of around the risk profile. Direct lenders traditionally could take a little bit more risk than banks, and in PE, banks over the last few years have been kind of just generally retrenching. But within infrastructure, my understanding is the debt dynamics are a little bit different.
You mentioned it, so I'll follow up. But direct lending, how active a role do you expect those guys to play in infrastructure going forwards?
So, just today, Brookfield announced it's raised a $6 billion infrastructure debt fund. So, there will be activity there. We spoke earlier about managers, buying infrastructure managers, and a similar kind of dynamics going on in the debt space with kind of, lenders looking to expand in various ways, whether it's, even an impact debt fund or an infrastructure debt fund. Again, they need to have the kind of inbuilt expertise to convince LPs to back them. But certainly there's room for it to play a bigger role, especially for any of the slightly riskier, maybe newer technologies and assets that banks perhaps will be a little bit more wary of. So yeah, my understanding there as well is there's quite a lot of potential.
There's an interesting dynamic also happening that I hear about, which is the shift of value from equity towards debt or credit in this segment. And it's sort of understandable, because when you think about a core plus investment strategy getting at best sort of high single digit returns versus what you can get in credit right now, it's very hard, to see why you would go the equity route, right? So when you at an arguably lower risk profile, you could actually go into the debt side. So I do think there's an interesting dynamic here happening in the infrastructure side.
With some of those continuation points in mind, do you have a feel for how LPs are generally kind of receiving that as a strategy by GPs versus entirely new investment?
It depends on the LP, I would say. So some are maybe more traditional, take a slightly more conservative approach, and either due to resource constraints or kind of on principle, they don't want to be making asset level decisions themselves. they diligence their GPs, their managers, but they don't necessarily be wanting, they're not wanting to have these opportunities on a single asset basis brought to them. They're thinking about capital allocation on a kind of broader asset class basis. So some are still, a bit wary. I think we're at quite an interesting time with continuation funds we will be, next year and the years after as well, because we've seen such a wave of activity. GPs are going to need to kind of bear out their thesis of why they put those assets into a continuation fund in the first place. So that's something we're kind of keeping an eye on. But, broadly, if they are used sort of correctly as a good liquidity solution, the thesis is right around them, LPs are receptive, and it might mean that they can get exposure to an asset in a slightly different structure from the kind of main flagship fund and for longer, and realize some of that value later down the road. So slightly depends on the LP type, but yes, I think the jury is still out. There's still some skepticism, but it's a massive industry, the secondaries industry. So watch the space.
Peter, one for you. We talk often about stranded assets in fossil fuels. How do you think about the risk of stranded assets in sort of energy transition related assets, particularly with the technology landscape shifting so quickly?
It's certainly high. That it can happen, although even legacy like oil and gas always seems to find a way to do it. But look, things can get renewed at cheaper cost. Maybe I would point to what we've seen in Greece as an example, and that 25 years ago they invested in all kinds of wind power, and now they're replacing all those wind turbines with newer ones, and they've got a good construction infrastructure, construction industry in place to develop these things cheaply, on time, on budget. So there is a way, and it's profitable. So, I think that's kind of maybe a unique situation, but, technology has been a big part of the solar story. The assets aren't, built to run for, decades upon decades, but, new things do come along, and there's been, a consistent way of updating the assets.
Another one for you, Peter. How do you view governments as potential exit opportunities for sponsors or for asset owners? Do you see governments as buyers for large platforms of assets in some point in the future?
Well, I tend to see governments more on the front end in terms of building things up front, or being partners or providing the opportunities, where the capital is needed, in the early stage. When things start to cash flow and become a bit more predictable, there are more options other than just these things can be like mega projects, but for sure. But there are more options for owners or financiers, and even on the debt side to handle those assets, as long as like the maintenance expense isn't incredibly high. But most of the capital has to go in upfront, and that's where we see governments, more likely to play.
You've given some of maybe the national security aspects around the TMT space in particular. So we're talking data centers, we're talking about networks. Do you think that's different to more traditional infrastructure and will imply a more kind of robust government presence in that space relative to, say, toll roads or bridges or what have you?
Well, I think we're finding just more interventionist government everywhere, in all aspects. Whether we like it or not, there's just a lot more regulation that has to be met at all points in the supply chain, and it's just frankly making it more difficult to invest in specific areas. So I would say as if a few years ago, government affairs seemed kind of a boring part of a lot of companies, but certainly not going forward.
Understood. Thanks, Peter. I think look, in the interest of time, I think we're pretty much there. So let's wrap up. I mean, first and foremost, I'd like to thank the panel, Joshua, Harriet, Peter. Thank you so much for joining me, and also a big thank you to the audience, and a quick reminder that ThirdBridge provides investors on a global basis with an integrated suite of research solutions. So if anybody would like to get in touch and read any of our industry-leading content or speak with any of our industry experts on the infrastructure space, please do reach out and get in touch and see how ThirdBridge can benefit and meet your research needs. But with that said, thanks again to the panel, and thanks again to the audience. I hope everybody enjoyed the discussion as much as I did.